and welcome to the wildfire insurance segment of the evening. We are delighted to have as our featured speaker United Policyholders, a consumer advocacy group on the insurance topic, named Joel Laucher. And he will be joining us shortly to go ahead and go over some recent developments in the wildfire insurance space. But I'll just start it off by saying the Topanga community is one that is in a very high fire hazard severity risk zone. The entire community is classified as such. Over the last year or so, actually 2 or 3 years, private insurers have been becoming a lot more, I don't know, I would say picky about whom they insure, and they've been trying to basically reduce the risk of loss and have been dropping policyholders en masse, essentially, and not allowing them to get any sort of private coverage, basically forcing a large number of Topangans onto something called the FAIR Plan, which is the insurer of last resort. It's basically a compendium or a consortium of all the different private insurers that pay into this pool and then provides this coverage. The problem with the FAIR Plan is that it's expensive, very expensive, and provides limited coverage. So basically, in addition to buying the FAIR Plan, you have to then do a wraparound policy. Long story short, we're in one of the worst positions possible in the state in terms of the number of people forced onto the FAIR Plan. I mean, we may be literally the worst. We're like top 5. So we are really at the forefront of those getting hit the hardest by these sort of new muscle flexing by the private insurers and then the regulatory changes that are coming down the pike. So everybody's scrambling, trying to, like the regulators, the legislators, the governor, everyone's trying to come up with strategies to keep private insurers, writing policies in the state for everybody, like people in low risk areas and high risk areas, and keeping it affordable. I think we may be making progress on keeping insurance accessible, but not affordable. We'll see, though. We're going to have our policy expert discuss with us some of the things that Ricardo Lara is proposing. The regulatory changes have not been finalized yet. They are proposed, but they look likely to pass and be implemented at the end of the year. Laura has been meeting with them over the past 7 or 8 months to basically iron out some of these changes. So with that, I will turn it over to Joel Laucher and see what he has to say about what is coming down the pipe.
Hello, hopefully everyone can hear me. And thank you for having me. I do work for United Policyholders. We're a nonprofit. We have established our reputation essentially around helping people deal with catastrophe losses, claims after wildfires. But in this current marketplace where the challenges of even getting coverage are really difficult, we have expanded into trying to assist consumers with finding coverage as well. So next slide, please. So just a little bit about United Policyholders. I mentioned we are funded by donations and grants. So the people we assist with either claims or finding insurance do not contribute or have to pay for any of our services. Next slide, please. I have a lot of slides and a very few allocated minutes, so I'm going to try and move through these quickly. But you're probably already familiar with the current situation, and that is it's hard to find insurance. And if you are able to find an insurer that will write you, the premium has gone up significantly in the last couple of years. I'm going to get into a little more detail about how that plays out. But very challenging, of course, for your community in particular, but for a lot of communities in particular are in this same situation. Next slide, please. So one thing we do still like to reiterate, despite the fact that insurance premiums are going up, it isn't a time to allow your limits for your home be inadequate. The purpose of homeowners insurance or any type of renter's insurance, condominium, HOA insurance, is to rebuild if you were to have a loss. And nobody ever thinks they're going to have one, but we know in many communities in California have gone through some major catastrophes over the last 20 years. And everybody is very grateful for the amount of coverage they have and generally wish they had more. About 80% of consumers end up being underinsured pretty significantly and then have to borrow more or spend more of their own money to rebuild. And in some cases, they just have to sell their lot and move elsewhere. So despite the current situation, try to get an estimate of about what the cost per square foot is in your area and try to be at least within the range of reasonable of being able to rebuild your home with your homeowner's limits. Next slide, please. Another thing we always still remind folks to do is to inventory your personal property. You may not know this, but if you have a significant loss and you want to claim, to get compensation for your personal property losses, you're going to have to list every single thing that you own that you are claiming was destroyed. You're going to have to say when you bought it, how much you paid for it, and what condition it is in now, at the date of loss. That is quite an undertaking. And while it really is challenging to go through and kind of record that much detail about everything in your home, we do say it can be very helpful if you would simply take your phone and walk through your home and take a video of everything you own. That means opening cabinet doors in your kitchen, the closets in your bedrooms and your drawers of your dressers, everything. And those videos actually have played a role in many claim situations to convince insurers that, yeah, it looks like, your loss equaled your contents limit. And in many cases, they waive the requirement to go through that whole cumbersome process. So again, there's a lot of important little things that you will forget that you had once you're in this kind of situation. Hopefully you'll never need it. Hopefully you'll never need to know these things, but taking a few minutes to walk through and do your inventory is worth the bother, in my opinion. Next slide, please. So if you have been non-renewed, and a lot of people in California are in this situation in the last 2 years, probably more than ever in our history. So your insurer has to give you a 75-day notice and tell you the reason that you are being non-renewed. Arguably, and unfortunately I'm using that word, if you are able to remedy that reason, for example, if they say, we're non-renewing you because you have a wood-shake roof, and in those 75 days, you are able to get a composition Class A roof installed, they should be renewing you. But that is a legal fight. Some insurers have conceded that, many haven't. So, do what you can to remedy the situation they are citing if you can. And in many cases, you can't because it's something about the location of the home. But try and remedy it if you can, but also immediately begin shopping for insurance. As you probably know, if you're even bothering to listen to me, it's not usually because you love insurance, but because it's become a challenge. And that means you're going to have to hunt for a lot harder than you might have otherwise, when you typically would have just called another agent in your local community to find coverage. Now you're probably going to want to start with your local agents, but range much outside the area if you need to call agents in areas where they're not being overwhelmed by calls, right? And finding insurers that you might not have even thought existed before. I live in a town called Moraga, A couple of my neighbors were non-renewed. They ended up with Amica Mutual. That's one you may have heard of, but it's one many people haven't heard of. Another company that stopped writing new coverage was called Tokyo Marine. Most of you never probably knew Tokyo Marine existed as a homeowners insurer, but they do, and I believe they've started writing some new coverage again. So please come to the United Policyholders website. We have information. You can see one of our pieces right there about being dropped by your home insurer. Take a look and see if there's some information we can help that we can provide that might help you search the market. Next slide, please. I'm also going to recommend that you go to the Department of Insurance website. If you look under homeowners insurance and then look for the top 10 tips of shopping for insurance coverage, it's a webpage I actually put together myself when I worked for the Department of Insurance. But that top 10 tips has not only an insurance finder tool, which may or may not pay off, but it also has the list of the 800 numbers of every admitted insurer that writes residential coverage in California. So, you know, this could be a wild goose chase or a very frustrating thing to do, because you can go through all this and still not find coverage. I say that right out front. But if you want to do the best search you can, at least, you're going to go through this process and call each one of those 800 numbers, ask if they have an agent nearby or if they will quote you directly. And again, there's a lot of insurers you may not have heard of that write coverage, and you may be able to find a coverage that way, right? This is, you know, when all else fails, you got to go to great lengths to, you know, try every means possible. This page gives a lot of means of how to search the marketplace. If you can avoid it at all costs, you want to avoid the fair plan, and you really want to avoid surplus lines carriers as well. The reason is admitted insurers, what we call that, ones that whose 800 numbers are listed there, they're backed by the California Insurance Guarantee Association. So all those insurers kind of pitch in when one of them, if one of them were to go insolvent, which almost never ever happens, but one did go insolvent after the Paradise Fire. So and then those losses were picked up by the California Guarantee Association. The fair plan has its own reserves, right? Because it charges a lot of money and it builds up a lot of reserves. So it will pay its own losses. But if it didn't, it would assess every admitted insurer based on their market share in order to pay the fair plan's losses. So the insurers aren't funding the fair plan day to day. They fund the fair plan, funds itself, pays its own claims. But if it did run out of money, then it would do an assessment on the industry as well. So that's great, you know, financial security with admitted insurers in the fair plan. For surplus lines insurers, the only thing you can look to is their financial rating, right? So you want to find a carrier that's A rated or at least B plus rated, because that is a very secure financial rating, usually referred to as a best rating. So try this webpage. Next slide, please. And again, about the fair plan, and as already mentioned, it's very basic property insurance. It's basically a fire policy. And it meets the mortgage requirements is essentially its purpose, and gives you insurance against the primary catastrophic loss peril. But the second most common loss that can be a major loss is a water damage loss. Fair plan policies don't cover that. A kind of loss that is very rare but can be very expensive is a liability loss. Somebody trips and falls on your property, for example. Fair plan doesn't cover that. That's why you do have to buy a difference in conditions policy, sometimes called the DIC, sometimes a wraparound. They're both expensive, and they're a doubly expensive combination. But if you want to have full coverage and you can't find coverage anywhere else, the FAIR Plan is where you might end up. And I will say, if you do end up there, don't let that be the end of it. Every few months, whenever you can kind of muster the gumption, to use some old terms, to go through the whole shopping process again, do it again, because you never know when a carrier might free up a few more spaces that they're willing to write. I've had that happen in my community, and it's always a possibility where a carrier, will get a different reinsurance coverage and write a little more. Some of the smaller carriers are seeing this as somewhat of an opportunity, although they really don't want to build up a high wildfire risk portfolio either. Next slide, please. So again, with the FAIR Plan, you need a difference in conditions policy to essentially equal what is a standard homeowners policy. Next slide, please. So you do need to talk to your agent. Even the standard FAIR Plan policy, what it does cover, it just doesn't have the breadth of coverage for those particular coverages that a homeowner's policy has. So you're going to want to bump up some of the coverages even in the FAIR Plan policy that includes. For example, I think building code upgrade might be at 5%. That's the difference that you'll need to meet current building standards if you have to rebuild. A standard homeowners policy has 10% building code upgrade coverage. You usually need every one of those percentage points, every one of those dollars, to build a current home if your home is 15, 20, 30, 40 years old, built to different building code standards. So again, there's a number of FAIR Plan add-ons. I'm going to talk to your agent about that as well. Next slide, please. So I will say the FAIR Plan does give discounts they're the same safer from wildfire discounts that every homeowner's insurer by law has to give in California. The only thing is, for the FAIR Plan, you have to do all the landscape ones to get the landscape discount, and all the building ones to get the building discount. Building ones such as mesh over your vents that's tamper resistant and covering your gutter guards, Class A roof, for example. But you have to do all of the building ones or all the landscape ones to get the discounts for those pieces. For every other admitted insurer, each one of the discounts, each thing you do among those discounts or among those mitigation actions, will get you a discount. So next slide, please. And again, I think this PowerPoint, hopefully, or this presentation will be available to you. So one thing you should know about how insurers charge premium, it's based on a number of components about the home. And I will mention the very high fire hazard severity zone isn't something insurers use. They have their own measures of wildfire severity risk that they use. What you're looking at is one of them. They use risk scores based on your home's location. For many years, it was based simply on slope, fuel, and access. And in this picture, you can actually see this is kind of a satellite view of your community generally. And in the middle of those two circles are two separate homes. And even though those homes may be only a few hundred yards apart, they may have wildly different wildfire scores based on the risk models that insurers use in their rating process, right? For these scores, there really isn't a thing you can do personally to lower your score. It's kind of, it is what it is. And even though they told you the calculus for it, the slope fuel access thing, you don't have enough control over even the fuel component to change that. It could change with something like a community level activity. such as a controlled burn or a shaded fuel break type thing, that might have an impact, but individual homeowner activities don't make an impact. However, the tools insurers using are getting more granular. Next slide, please. So instead of satellite imagery, they're now using aerial imagery. And with aerial imagery, they can take in a lot more information about the home. Plus, they build in information into their database about the year built of the home. So they know some of the, what vent codes were in place and such, for telling, some of the components of the home. Some of these you're going to need to tell your insurer if you have updated your home since. But under this aerial imagery, insurers are able to look and see, for example, if trees are growing over your home. And again, I mentioned if you get non-renewed, an insurer has to tell you the reasons why you're non-renewed. This might be one of them. There can be issues with aerial imagery. And if there are no trees, limbs growing over your home, you should contact your insurer immediately and say, either you have that wrong, or that's an old picture a month ago. That might have been true, but 3 weeks ago, I had all those trees trimmed back. But insurers generally can see a lot more about your home. They can say if you have defensible space. And this is one of the reasons insurers don't really do inspections so much anymore, is because they use these tools and make their judgments accordingly. If they've got it wrong, again, you need to let them know. Next slide, please. And again, when an insurer files rate increases, this has been the crux of the current crisis. Insurers want to charge a lot more than the department's current regulatory process would allow. And, insurers have been asking for smaller increases to avoid consumer group interventions. So they've typically come in under a 7% threshold, but now, they feel they can definitely prove they need more. This is the most recent State Farm increase I'm using as an example here. The overall increase, meaning on average of this for the whole State Farm book of business, was a 20% increase. But that's an overall average. I'm showing you here on this slide some how that actually played out for some different zip codes. I gave a presentation last week in the community of Orinda in the East Bay. Also has some hillsides. They still, overall, their average increase was 17.6%. So that's first column. Your zip code, I think I have it right, 90290, is that correct? Unfortunately, your average was actually more than double the average of that State Farm overall increase, 46.5%. And the average premium increase was $2,300 essentially. The highest increase someone in your community received was a $28,000 premium increase. So maybe you can be grateful that's not you. I'm hoping that was a multimillionaire, and $28,000 doesn't mean anything to that person, but that's a pretty big hit. And just to give you, find somebody that's paying a little more on average, another beautiful coastal community, Big Sur, you can see their average increase was 48.7%, and a little higher general average, but a lower maximum increase that they experienced. So, this, you hear a number and you think, well, I'm going to get a 20% increase. But again, it varies very much based on your fire protection class, that wildfire risk score, the age of your home, your zip code, a whole number of things, the type of construction you have. There's 20 elements that may go into a home's rates. So the fire score has become a big part of it, protection class a big part of it, but there are other items as well. Type of roof is a big one. Next slide, please. And if you need to cut me off, feel free. I understand. I think I'm running over.
You're doing so great. I have to say I am entranced. But yeah, keep going.
Uh, okay. Well, hopefully everybody feels that way. And by entranced, I hope you don't mean you drifted off. But
No,
here we go.
riveted.
Riveted. So that's what the frog said. The the commissioner's proposal of what he wants to do is essentially allow insurers to use projections of loss from wildfire risk models. So there are entities based actuarial firms basically that look at past losses over many years and many historical fires and project what and look at the build out of a given region and project what the future losses of will be in that region based on an individual insurer's book of business. Yeah, right. How many homes it writes and the values of those homes and the types of homes those are, wood frame, this and that. And in California, we don't allow those projections of loss. We simply take averages of historic losses and use those averages to load up the insurer's rates. Well,
Joel, sorry to interrupt. I just kind of wanted to highlight, if you don't mind, and if you do mind, I'll shut up. But I wanted, because we are running a little low on time, I wanted to just quickly put this into like context for people. So this point that you're making very well is one of the controversial changes that Laucher is proposing, because he's switching from what was a historically based rate setting model to a prospective one. And based on what I've seen, not only is that a sea change, but I understand that's what a lot of the rest of the country does. One of the problems with what he's supposedly going to allow is not only is he allowing this prospective where they can kind of put whatever they want into the model, I mean, within reason, you'd like to think, but what I've heard in some of the articles I've read, and maybe it's just fear mongering on the part of Consumer Watchdog, I don't know, but they're saying we won't even be able to scrutinize this model, this black box proprietary model. So not only will they be able to look forward looking, there will be no accountability on the model itself. So I think that's a big concern, and I'd like to push back against that. And I think we should all be pushing back against that so that there's more accountability on whatever this new forward looking model is. Just
yeah, I do think it's a major challenge. It is the firms that do the models are for-profit firms working with for-profit insurers. And, there are multiple modelers out there and they all come up with different results. And, there's a lot of science that goes into it, and a lot of math. And, there will be a process to validate those models. But this is there's no certainty. I when I was with the department, I saw two models. One would be double the projection of the other, and this was for the FAIR plan, which already does use models. So I'm not personally a fan of this approach. I do think the current approach could be used, but trended forward rather than just using historic losses, put a trend factor in and wildfire risk scores and use more statewide data rather than just individual insurer data. But yes, this is very controversial, and it will be hard to really vet those models with anybody other than another modeler who knows how to, read them.
Yeah, no, exactly. And I agree with everything you just said. But let me ask you this, because one of the things that's frustrated me, and I so apologize for jumping in, but I'm trying to turn this into an actionable item, that things we can move forward on so that we can push back against some of the proposed changes before they're like implemented legally. I'm hoping United Policyholders, I see you as a consumer advocacy group. And the other one that I like as well is the Consumer Watchdog. But what I'm frustrated with, Joel, and maybe you can help us learn how we do this. I want Topanga, people like the board, the town council, and residents, realtors, to have a seat at the table, because we're one of these communities, as is Big Sur and a few others, where we're really getting hammered by all of this. We have a lot of valuable input. We can speak to experiences we're having on the ground. We also have a lot of really smart people. Like, we should be able to weigh in on how some of these changes could be tweaked a little bit to be fairer and to, not create an uproar, like an uprising. Like people, this is going to be really problematic for us. Like, and I feel like tweaking a little bit, like you just suggested with the model, rather than moving to a full-fledged perspective black box model, maybe we take a historical model, which is at least based in fact, and then maybe put like you said, like a future growth factor, risk factor on it. But how can Topanga? Can we join you? Can we hold your hand? Can we get a seat at the table with Laura's office so he realizes what communities like ours are dealing with? How do we get
Yeah, yeah, there's two ways. One is they will hold a hearing again about this change in the regulations. And two is your elected officials, your assembly member and your state senator. They need to weigh in on this. This is, I think the industry feels that, they have stopped writing new coverage in a lot of areas. And I think they're going to hold out, hoping, the commissioner looks like he's going to make these concessions. I do think he needs to make some level of concession. But I think for me, this is too far, but I don't even necessarily speak totally for United policyholders on this. It's just my belief on my personal journey. I was
and years of experience at the CDIN. So one other thing, and I agree with you, Joel, totally. One other thing I wanted to bring up while I have you here, and you're so knowledgeable, I'm in love. Okay, but the other kind of controversial change that's being allowed is the allowing the insurers to not only incorporate the forward-looking risk model, but also to incorporate the cost of reinsurance.
correct.
And like you were alluding to earlier, the reinsurance market is one of these sort of like global, unregulated, like it's one of these other catch-alls. If they're allowed to incorporate the cost of that into their models, it's going to be one of these other things that allows them to just spike the rate. So why not? Tell me this, Joel. Have you seen and heard of Schiff's, Congressman Schiff, soon to be Senator Schiff, his bill called the Insure Act that he introduced in January 2024, which essentially provides a federal reinsurance market. So it enables the insurers to get off of that, loosey-goosey global reinsurance market and rely instead on a guaranteed federal reinsurance market where the cost will be very firmly contained and easy to tease out, so that we won't be stuffed as policyholders with this, broad insurance. It's essentially, it provides a backstop and should serve to incentivize a lot of insurers to come back to the market because they'll be guaranteed not to take a catastrophic loss. How do you see that fitting into these state level changes?
Yeah, personally, I think that would be nearly an essential move. I have this alternative that I have mentioned to the department, which is simply allowing, there is a cap on insurer expenses and a profit loading. I had suggested, well, let's just give a certain percentage more than we give today. So it's better than insurers have today, but it won't fluctuate or be whatever the reinsurance market demands, knowing that it's a pass-through, right? I mean, right now, I'm sure insurers themselves fight back on reinsurers because they have to eat these costs. But if they can pass it through, they will, I assume insurers will play less hardball with reinsurers. So I'd rather just give them a fixed percentage, or I very much like the idea of the government providing some level of reinsurance. And of course, this isn't a California only scenario. Many other states are in worse catastrophe situations than we are, Florida, Texas. So, there is a need for it. So it's a discussion maybe we can have.
Right. But those are the
later.
two big ones that Laura's allowing
Yes.
that I think we could do better. I don't like what he's allowing. I want to speak up at the public hearing, but great. All right. So let me go ahead because we are running out of time. I could go all
Okay.
day with you on this. It's great.
All right.
If you
Let's
just wanted
surge forward.
maybe 3 more minutes to wrap it up, and then I want to have some questions.
Okay. Let's. So again, the agreement from the commissioner, what he's looking for, he's going to allow all these additional costs, but insurers that then would have to commit to writing 85% of their market share in higher risk areas, like your own, for example. So for again, the example, State Farm writes 20% of California. It would have to write 85% of that, or 17% of the homes, let's say in your community. Now, whether that will happen ultimately, or how long it will take them to get there, or whether they will instead diminish their market share because their profits will go up writing less business, given these new models and reinsurance costs being taken care of, we'll see. So next slide, please. Okay, one thing I have to say to everybody to lower your premium is raise your deductible. I myself, had homeowners insurance, same carrier 20 years or whatever. When I purchased that insurance, I had a $500 deductible. Wow, that's a lot of money. 20 years later, because I don't look at my insurance enough, I still have that $500 deductible. I'd never make a $500 claim, right? Or $600 claim. You want to have a $10,000 deductible if you can, or $20,000, whatever you can afford to absorb yourself, because you don't want to be making small claims. That creates a claims history and may clue an insurer into something it doesn't like about your home. So raise your deductible as significantly as you reasonably can afford. Next slide, please. There is, again, I'll have you check out the Safer Than Wildfire discounts. Every insurer has to offer them. Some of those discounts are still pending with the Department of Insurance approval, but they all have to give this community level designation, Firewise USA, lots of those out there. Next slide, please. And then there's a set for building hardening. Each one of these, other than with the FAIR plan, is an individual discount. Fire resistant vents, enclosed eaves, that's one of the hardest ones and more expensive, but the other ones are achievable. Next slide, please. And again, property level ones, 5 feet around your home, things you should be doing. I know, every home in my neighborhood has hedges right in front of the bedroom windows in front of the house. They've got to be moved back 5 feet of clearance. So look at the Safer from Wildfire discounts and please implement them. Helps you get insurance and it helps protect your home. Next slide, please. And please take our survey or check us out at uphelp.org. Say how great it is that we're out helping your community. Even if we sent not the greatest speaker to your particular community, you're glad that we do this kind of work in general. And thank you for having me. And do I have a next slide? And again, we do have a lot of information on our website, uphelp.org, that is, that you can find to help you, reduce your risk and search for insurance. Next slide, please. And we have county by county information, and as part of our WRAP, we have monthly meetings, wildfire risk reduction and asset protection. That's our WRAP program. Check that out on our website. Next slide, please. And disaster ready guides. We have all kinds of information. Next slide, please. Listos is a great source, uphelp.org.